note, I will pass it over to Matt if you want to give a little introduction and then get started whenever. Then, if anybody has any questions, you can utilize the hand raising function or put something in the chat. I'll be keeping an eye on that. And I can flag Matt if you guys have any questions while we go through this.
Yeah, that's great. Thanks, Brittany. Can everyone see the presentation that I'm
Yeah.
sharing? All right. Okay, great. Just a brief kind of background on myself. I'm currently, chair of the TSCC. Have been on the commission for 4 years now. Professionally, I am a public finance banker and advisor. The way I interact with Oregon's property tax system is as a consumer of information and as inputs to analysis for my clients in terms of things like projecting geo bond revenues or disclosing property tax information related to debt transactions to people like credit rating agencies or investors. So I wasn't willingly become a nerd on the Oregon property tax system, but it's kind of crucial to my job. I've been interacting with that and professionally for about 15 years now. Um, for this presentation, we're going to go over kind of the overview, the basics, a little bit of history, give some examples, get into some math, and then talk about briefly at the end, I think, just what some of the criticisms or constraints are with the current system and maybe some ideas about how folks want to fix it. Um, and then there's also lots of other great resources online from TSCC and Department of Revenue or other assessor page, county assessor websites that you can um, go to if you want to dig even deeper into the Oregon property tax system because it is quite complex. And we're only going to kind of scratch the surface here. But I hope we'll hit some of the issues and clarify maybe some confusion that folks might have about how the system works. So, we'll start with what I call the before times. And this is pre-1990, before Measure 5 was passed. So how people dressed in neon and carried around boomboxes in the 80s, if those folks are old enough on the call to recall that decade. So for decades, Oregon had what we refer to as a levy-based system which essentially the district governing bodies would come up with a dollar amount that they wanted to raise from their property taxpayers in their district for the revenue during their budgeting process. And then they would submit that dollar amount to the assessor. All properties were assessed at what the assessor appraised would be considered their market value. And then the assessor turned that dollar amount of the levy divided by the property tax base of the market value of homes in the district, and that became a rate which was applied to everyone's property taxes. There were limitations that you couldn't grow your property tax base by more than 6%. There were these things called serial levies, which districts could use to supplement their property taxes. And School funding, kind of as a side, was very much more locally funded than it is now. And that across the state, there was a disparate level of taxation between school districts of what they tax and what they spent. Uh, so some folks, I guess, we're not happy with this system. Property taxes in some places, 6% every year over year. You can see how that can accumulate and start hitting people's pocketbooks. So there it was here in Oregon, as there were in other places in the country, most notably probably our neighbor to the south, kind of a property tax revolt, brewing. And so that sort of politics led to what the two constitutional measures that really reshaped our system and give us what we have today. As I said, there's additional resources, and if you want to go very deep into the history of Oregon property tax system, the TSCC has a document on its website, which I'll link to at the last slide, which is a history of Oregon's property tax system, which I think it's about 130 pages. So I've definitely referred to it for this presentation, but you can go into way more detail. Thank former TSCC Executive Director Tom Lindhairs for that document. So, Measure 5. It was put on the ballot, written primarily or promoted by this person, Don McIntyre, who was a property tax kind of gadfly, or sort person who was very critical of the system and how much it was costing taxpayers. It did pass by much. It only passed by 52%, and it only out of 14 out of 36 counties. And notably, again, some sort of political history, only two, I think, of the 8 counties out in Eastern Oregon passed it. And so, as is maybe typical here in Oregon, felt they were kind of imposed upon by the voting in the tri-county area here for this new property tax system, which they weren't necessarily happy about. So what Measure 5 did briefly is that it retained the levy-based system mostly. Uh, the districts could still put a dollar amount of property tax revenue they wanted to into their budget and submit it to the assessor. And it retains those limits year over year. But what it also did was impose limits on the total amount of property tax rate a taxpayer could pay. And while initially it set the real market the limit for education districts at $15, over a few years it ratcheted that down to what we have today, which is a limit of $5 per thousand of a property's real market value for uh, the aggregate of education districts the taxpayer is in, and $10 per thousand of real market value for general government districts. The aggregate of all tax rates of those districts could not exceed these limits. So what Measure 5 did, and we'll talk about this in more detail later in the presentation, is it introduced the concept of compression. So you take the tax rates of your education districts, and if they add up the school district, the ESD, the community college, that adds up to more than $5 per thousand on your tax bill, then your tax bill is reduces those rates from each one of those districts until you're only paying $5 per thousand for education districts. That restrained greatly the amount of money districts could raise, particular school districts could raise locally through their property taxes. So in order that we could still fund our public education, it had a provision where the state would use its mostly income tax revenue to subsidize now the school districts. So Measure 5, I think you could say the two big things it did was limit, the maximum taxes a property owner could pay, but also shifted the funding of public education in Oregon from mostly local to mostly state funding. And then we get into the whole thing where We have a state school fund formula that allocates a per student funding mechanism to try to equalize school district funding across the state. So that went on for a few years, but the tax pirates, or whatever you want to call them, revolutionaries, Jacobins, were not done yet. So we had another measure, which the myth is that it was written on a napkin at a over a dinner or a cup of coffee or something like that. And that was Measure 47. Now, Measure 47 was passed by the voters, um, but it had a lot of problems with it, and the legislature had to uh, do some fixes and put out a new measure to replace basically which was an unworkable um, constitutional measure there for 47. So we have Measure 50, which was approved in May of 1997. So this completed the transition from a levy-based system where districts submit a dollar amount and it gets turned to a rate. Now districts um, just have a rate, and then the rate determines what dollar amount that they get based on the property values in their district. So it established a permanent rate for all taxing districts in the state. So essentially, it took what rates were in 96 and 97 and froze them for all of the districts. So a school district was levying, on the prior system, $2.50 per thousand. Now that's that school district's levy rate going forward in perpetuity. Another thing that it did is that it separated the assessed value from a property's real market value. So now the property would have two values tracked by the assessor: an assessed value, which is what the tax rates are applied to, and then what normally we're used to thinking of a property value is what your property would sell for at a fair market price. And it also created this concept of maximum assessed value. And that maximum assessed value would only grow 3% annually, year after year, with some exceptions, where if you do some major renovation or other, there are sections, but primarily almost everyone's property assessed value is increased 3% a year, with the caveat that a property assessed value cannot exceed its real market value. So as we had in 2008, huge real estate crash and real market values dropped like 20%. Some places, in Bend and particular, Central Oregon, those real market values fell below their assessed value. So now that lower value is going to be your maximum assessed value because it's the lower of the two. That was kind of a weird time, and if we have questions about that, I can get into that more. But what it did with the assessed values at the time is it took your property, what was its real market value in 95, 96 tax year, and gave it a 10% haircut. And then from year after year, your taxable assessed property value would only grow 3%. So it eliminated the approved district tax bases and the 6% growth that had existed prior to Measure 50. So a couple notes about additional tax levy above and beyond what became the permanent levies for the districts. General obligation bonds are still exempted from all of these limits, essentially to preserve the general obligation pledge that a tax district will levy whatever taxes it needs to in order to pay debt service to the lenders and investors. And then it introduced the concept of the local option levy, which replaced kind of serial levies as the option for voter approved increases above their limited um, uh, tax rates. So after Measure 5 and Measure 50, we have primarily, there's been some tweaks, but primarily we have what the property tax system is we live under today. So again, now it's rate based. All these districts, they have a permanent rate and they submit that to the assessor, and the assessor uh, tells them what their tax base is and then delivers their tax revenue based on that calculation. We have a 3% growth on property assessed value. We still have the Measure 5 limits on the tax rate per thousand, $5 for all of the education districts rates, and $10 for general government rates. Now, this is where it gets tricky. So, and one thing I hope to take away from this presentation is that the complication that these two measures kind of created was that your taxes are based on this taxable assessed value that you have, which was established in 96, 97 and has only been growing 3% a year. The limits are based on your real market value assessment of your property. And that real market value grows according to how the real estate market grows. And aside from that kind of weird time in 2008 to 2010, Oregon property values, residential, and I guess I should note that this presentation is we're going to talk about residential property taxes, and um, just I think that's what most people think about property taxes, and in commercial, industrial, personal property stuff is a separate issue, which has some of the same issues, but that involves some Department of Revenue assessments, and so had to leave some stuff out. So this presentation, we're going to just focus on residential property values. So when I'm talking about property values, I'm talking about residential. Those limits are based on the real market value. So you have to go through this process of calculating your taxes on one value, the assessed value, and then checking it against the limits on this other value that your property has, the real market value. So local option levies were allowed within the Measure 5 limits. So districts can, with voter approval, install a 5-year operating levy, so revenues that can go for um, operating expenditures. If they want, they can go out for a 10-year levy, and for if the uses are going to be for capital projects. And again, the geo bond levy rates are outside of any of these limits. So sometimes people will be like, well, I thought how come I'm paying this, $7 per thousand on my real market value. The limits are 5,000. That's because there's $2 of bond levies added to your permanent rate or your local option rate levies that you're paying. So here's an example that I pulled from one of these bond documents that I work with, and how we disclose. This is for Clackamas Community College bond deal that I worked on. And this shows you a specific code area in the Clackamas Community College taxing um, base, I guess you could say. And you see we split it out between general government and education, the permanent rate, the bond levy rate, and the local option rate, the three types of property tax rates that can be levied in a district or on a property. And I always love vector control. I don't know, that's always my favorite taxing district. For those who don't know, it's like killing mosquitoes, but it sounds much or rats or nutria or whatever, but it sounds much cooler than that. And as you can see, like in this example, you add up the total um, permanent rate, it's under $10. Um, even when these are the rates that are applied to the um, assessed value. So it's at $6.70 per thousand. There's some bonds there, just add up to just under a dollar. And then you have some local option levies that are there, 93.9 cents per thousand. So looking at this, you would say, well, this doesn't look like taxpayer in this district would be in compression because these rates are below the $10 limit. Now, education-wise, you see we have the community college, the ESD, and the school district. This is a tax code area in West Lynn. And those add up just on the permanent rate to $5.79, about $5.80. The bonds are over $3, but those bonds aren't applied to the limits. But you have a local option rate of $1.50, which puts the non-bond levies for education on assessed value to be over $7 per thousand. So then you look at that and you say, oh, well, might be some compression there, but you can't really tell just based on the rates because the limits, again, are based and calculated against the real market value, and these rates are applied to the assessed value. So if you have if you have the assessed value rates at a much lower assessed value than the real market value, then you're still not going to get into compression. So I have an example here. We can kind of go through the calculations. So from that table above, as we just kind of went through, for the general taxes, the total tax rate on your bill for general governments would be $8.64 per thousand on your assessed value. Then the education, add it all up, including the bonds, be $10.47 per thousand. So total on your tax bill be like, okay, I'm paying around 19 cents per thousand all in on my taxable assessed value. But will any of that be compressed? So I just picked some round numbers, and for a property in West Lynn, you know, maybe this is on the lower side of properties in West Lynn, but um, and predicted that West Lynn properties since 1996, the appreciation on your real market value has outpaced the 3% annual growth on your assessed value. So for this example, we have a real market value of 650,000, but an assessed taxable value of 500,000. So if we take the general government rates plus the education rates, here's what you're on your assessed value. So 8.64 times 500, because it's on a per thousand basis, gets you about $4,300 of taxes. And then the general government, I'm sorry, the education at about 10 and a half, $10.50 on the 500 per thousand of your assessed value gets you to $5,200 for a total tax bill of $9,553.40. Now, but that is before we do the compression test to see if these taxes at these rates are exceeding those limits on the real market value. So the education non-bond rate times your AV. So excluding the bonds, you have $7.30 per thousand times 500,000 of assessed value. That gets you to property taxes, limited property taxes on education of $3,647. The Measure 5 limit, as we've gone through, is $5 per thousand of value. But as I'm hammering in here again, it's applied to your real market value, which is $650 uh, per thousand. So your Measure 5 limit on your education taxes for this particular property is $3,250. So that, as you can see, the taxes that they're paying are over that limit by $397.65. So for a taxing district, and this is done on a property by property basis every year, that difference between what would have been taxed had there been no limit and what you receive, because there is a limit, we call that compression loss. Now, the taxpayer might call it something different and call it compression benefit, but that's kind of how the math works. And this is done every tax year for every property, um, based on what their assessed value is versus what their RMV is versus what the aggregate tax rates are for that property, not counting any bonds. I'll pause there for a second. So more on compression because I think this is what causes a lot of confusion, and rightly so because it's complicated. So this compression, this reduction of the tax bill for a property owner based on the limits, or the loss of taxes imposed by a taxing district is the result of those Measure 5 tax limits. We didn't have compression before we had Measure 5. So as I went through, the taxes paid on assessed value are compared to the tax limits calculated on real market value, and the limits are calculated separately for general government and education. So it's not just looking at $15 aggregate that you can't exceed. It's just he has to not exceed the limits for each of those, for both of those um, tax rate limits. So this is just going, repeating what I went through in that little exercise. Um, One thing that we didn't talk about in that exercise is, and it's an important element of compression, and what many people might think is an unfortunate element of compression, is that the local option levies in your kind of aggregate tax rate are the first ones to be reduced, to get down to that limit. So if we look back in our example, the education district here has $1.50 local option levy. And so for this taxpayer, I don't know if I can do the math very quickly, but to the extent that the $1.50 on the $500,000, that tax payment on that local option tax would be reduced to initially before any of the other tax rates paid to the other taxing districts would be reduced. So if it takes more than reducing a local option tax rate to zero to reduce the property tax payers tax it to that limit, then we start getting into the other tax rates, and they're reduced on a pro rata basis based on what their tax rate is as a percentage of the total education taxes. So if you look here in this example at the education taxes in this code area, we could reduce that Westland Wilsonville School District local option rate to zero if the taxes paid are still over the limit. Then we reduce the community college rate, the ESD rate, and the school district rate until we get to a point where they're not over the $5 per thousand limit on the real market value. As you can see here, the Westland School District rate at $4.87 is primarily the bulk of the education the education taxes. So they would take on the bulk of the reduction of that compression to get down to that limit. Is it getting complicated enough? All right. So some effects of compression. So taxpayers are limited in the maximum taxes that they would have to pay, um, basically based a lot on their ratio of the assessed value to real market value, and as it interacts with the aggregate tax rates of everyone who they pay taxes to for their education and general government services. Um, Districts with local option levies forego those revenues first before the compression starts affecting the permanent tax revenue of any of the other districts. And certain taxpayers uh, don't pay any local option levy tax, depending on the situation of, if this taxpayer wasn't didn't have an AV of 500 and an RMV of 650, so that a gap, if they had an AV of 650, then that they would not pay um, anything over $5 per thousand, which would mean they wouldn't pay any of that local option tax at 150 because you'd have to reduce that by to zero before you get down to the $5 limit. So that comes up a lot when I'm working with districts and they're thinking about how to finance or raise additional revenues to finance a project or their operations is, this is going to hit, this new tax levy is going to hit very inequitably across your tax district as folks with different ratios of AV and RMV can pay wildly different amounts of the local option levy, which generally I think we think is not a fair way to tax people. And particularly, here in Portland and I know other communities, that historical anomaly of having the assessed values set in 95, um, different neighborhoods have had different real estate appreciation since then. And so properties that have the same real market value, so what we would consider the same, worth of a house can pay very different local option levy taxes just based on the path of the 3% assessed value growth versus the appreciation of property since that time. So some criticisms, which we've already kind of touched on, is that the compression can create inequitable tax situations. It's really kind of based on historical anomalies and not really anything to do with the properties themselves. Um, industrial, commercial properties, as I referenced before, are valued differently than residential properties. And so sometimes well, I know industrial, often it's the AV and the RMV are the same because that's how they're valued. And so, you have a district. I was working with a school district down in the valley who was a very large paper mill, and the value of that paper mill, its AV and RMV are the same, and they were trying to weigh the difference between a local option levy to raise revenues for some capital versus a bond to raise some capital. That big issue there was that if you did a local option levy, you have this huge taxpayer may be like 20% of your property tax value. If you do a local option levy, their tax rates were already above $5 per thousand. That mill is not going to pay any of those local option taxes. Whereas if you went with a bond, that's outside the limit. And so the mill would pay its share based on its share of the assessed value for that tax levy. And then, there's what also comes up kind of like in my world is that there's different school districts have very different permanent tax rates based on just where they were taxing in the mid 90s. And so that has been, set in stone. And so when districts go out to pass a bond, you might have a district whose education tax rate is, $3.50, and they want $1 or two for a bond. Their total education rate now is at $5.50. Another district, so you can see maybe that example of West Lynn, their permanent rate's already at $5. So people look at what their total education tax burden is, including the permanent rate and the bonds. And if that gets up to, $8, then or something, that, you could see how that make it harder to convince voters to a district that's asking for the same amount of money for a bond, and they're at $4.50. So some reform ideas. I know there's been a lot, and almost all of them or all of them have not gotten any traction. Unfortunately, when you tinker with this, there's going to be winners and losers, and the inertia just to keep it the same rather than kicking up controversy about folks who don't want their property taxes to increase. Um, it's been hard, it's been difficult, and meaningful reform for our property tax system has not gotten far. Um, One idea, this is what they do in California. Maybe that's why we don't like it because it was what they do in California. But take that assessed value and reset it when the home sells. So that doesn't affect the current taxpayer, and other places, which Oregon doesn't have to deal with. I lived in New Jersey for a few years where property taxes um, is a big issue. They have very high property taxes. Very good schools too, but they have very high property taxes. And then all the politics mainly around keeping grandma in her home and not, property taxing her out of the home where she lives in. So here in Oregon, because of that 3% assessed value, that's the other side of the spectrum where, we are inflating the value, but at a very modest rate so that folks on a fixed incomes can hopefully stay in the home if they want to. But resetting at the sale value at sale, that just affects the future taxpayer. But that would increase the tax bases of districts if we implemented that. Another idea is to exclude local option levies from compression, just like they do the bonds. So if the district voters want to self-impose more property taxes to pay for more services, why should that be subject to these limits? Because you're putting into the vote just like you would a bond. And then the other side of that thing, allow voters to increase their permanent rate. Maybe put it on like a two-thirds vote or something like that. But again, kind of to the idea that if the voters want to increase tax rates in their own district and they want to vote for it, then we should allow them if they want increased services. There's obviously other sides to each of these arguments, but that's just kind of an example of what's out there. I'm sure I'm missing a lot. So just some topics not covered because we, have a limited amount of time and I've already spoken for like 40 minutes straight about property taxes. Uh, and I feel like I barely scratched the surface. There's urban renewals, another can of worms. I referenced the different valuations for commercial, personal, industrial property. I didn't get into the strategic investment programs, SIP, or other property tax abatement programs, or the sort of discounts and deferrals that are embedded into the property tax system for things like farmland. And then, yeah, there's the whole mechanics of tax collection and appeals and that sort of thing. So,
Hey, Matt, we
um,
have a question in the chat.
yeah.
So it says, okay, so if a property RMV is now 950,000 assessed value and assessed value is 286,000 and a certified tax rate of 21.9692, this would be a RMV tax of 47,400 and an AV tax of 6,283 for a difference of 41,117 left on the table.
Um, yeah, so you're saying that, yeah, with such a high real market value, um, at the limits are going to be very high and as a dollar amount. So the the compression comes into play when your AV is close to your real market value. If you have so much room between your AV and your RMV, you're likely not going to be compressed. Am I following that? It's hard to.
I think they were trying to see if they were doing the calculation correctly based off of the numbers.
So you would calculate the limits would be calculated $5 per thousand on the real market value and $10 per thousand on the real market value. And then the taxes would be calculated on that tax rate, the $28 or something, on the assessed value, the lower number, the 250. So,
Um, Chris, does that answer your question? You put a follow up in the chat if you need more clarification. No, they said they have it backwards.
okay. Yeah. Yeah, it's not left on the table. It's kind of like we think about it as like the room you can tax on your assessed value before you hit your real market value limit.
I don't see a response.
Okay. Any
But
other?
yeah, there any? We can pause for a second, see if there's any other questions.
I was curious, Matt. Of course, we in our office hear some things about, some of the proposals that you talked about, reform ideas. And in the years that I've been working in local government finance, some of these have come up and gone away and such and such. But I'm curious, what have you heard recently in terms of reform? Like, are you aware of just generally speaking, if any of these have a likelihood of being addressed by the legislature anytime soon.
I don't have the closest ear to Salem, so I don't know, but maybe I'll call out Don Hudson, who I see is on the call here, if he wants to chime in, if he's able to. Don, are you there? Or do you just drop off?
No, I tried to unmute and everything. I was afraid that I wouldn't be able to hide in the back of the room.
No,
Uh,
gotcha, Don.
so reform has gone in my years of working on property tax reform from full legislative, blowing up the system and redoing, or bite to the apple. The biggest issue we have is that pretty much everything's embedded in the state constitution. So it takes a vote to make any reform. And of course, you spent an amount of time talking about the system, and it's very complicated, and trying to get people to understand what they'd be voting on is a concern. There was a revenue reform effort recently that's still going on. Part of it's with the League of Oregon Cities. Did a bunch of polling. I would say that reset at sale polls decently because people are like, well, you know, do things should be changing or be paying their own way. Um, One thing I would say that polls really well typically is they taking compression or taking local option levies outside of compression so that if you're voting on something, you're getting uh, the full revenue for it. The other thing is, I don't know if because I came in late, I was in another meeting, the change property ratio, which means what a new property comes in, the value that comes in on the rolls. For example, here in Washington County, an apartment complex comes in at about 30% of their real market value. Try providing services when you're only getting 30% of value. Changing that polls pretty well because people would like, new development should be paying their way of services. A lot of words to say we're not, there's not a lot of full traction yet. I think we may see some discussions again at the long session next year. Of course, there was nothing this year because there was so much to go into a short session. So we'll see what the appetite of any legislators of either referring something to the ballot or whether we're, again, looking at bites of the apple or full reform. My personal opinion, and this is just personal, is I think some of the bites of the apple you mentioned, taking local option levies out of compression, things like if an area votes on a issue or a local option levy and it passes 4 times in a row, then maybe it becomes part of the permanent rate because obviously your local voters have spoken, and so local control would be another key component. Beyond that, it's there are dialogues happening. You mentioned some of the reform ideas. Those are the main ones that are kind of out there. Uh, there's, I'd say, more traction than maybe we had a couple years ago, but I don't know what that traction will end up turning because I've seen traction in both directions in the 20 years or so that I've been working on reform. So sorry for the long answer. Hopefully,
Well,
I get your
I'm glad
question.
you were here to give it. Thanks, Don.
We did get a couple more questions too. So next one is, if we went back to the real market value, what is the estimated number of people that couldn't afford their taxes on the property? That is, what percent may need to sell to pay the tax?
That's a good question. I have no idea. Yeah, and I think that would be obviously, a big political issue with changing that. And I imagine, you could just that you'd have to work in some, um, as they did in the prior years, some kind of transition, um, to that.
And then the next question
I
is,
mean, I guess that would be like you assume like if you go back to real market value and remove the limits on property taxes. Because if we stop doing this kind of assessed value and it's just the real market value just moves up as it does, you would still have those, you would still be subject to those Measure 5 limits. So in that sense, it might not make a difference in terms of affordability of the taxes, depending on what you were paying on your assessed value, or how low it was below your RMV. If that makes sense.
And then next question was, I've been looking into a historical registry for our home in order to qualify for the property tax abatement program. Are there any other entry points to that program besides being on the state historical registry?
I don't know the answer to that. I don't know.
I
Allegra
don't
or anyone
know.
else on the call?
Yeah, I don't know either, but the county assessor's office for your county would be the best place to start with that. I would just either give them a call or send an email to see if there are other options. Yeah, we don't do that much with the exceptions and exemptions other than, know that they exist and see how they impact things.
Okay, do we have any other questions? And I'm not seeing anything pop up in the chat, but please feel free to unmute if you would like to speak and ask a question as well. But I will, oh, we did get another comment here in the, says, honestly, I don't think it would be hard to sell conservatives to go back to assessing value on real market value for both residential and commercial. It would need to start at 1% or something.
1% of as a tax rate. Well, I'm glad to see all you folks who came and learn more about the property tax system, and hopefully it cleared up any misconceptions or gave you sort of a deeper understanding of where we came from, where we are, and how it works.
And we did get one more, Matt. Sorry, we had another
Okay.
one squeezed in here. Says, is it common to see the RMV decline from year to year while the assessed value increases?
Not common, but it does happen. And I think it referenced the housing crisis in 2008, 2010 around. And this is a good segue because there is on the Deschutes County Assessor website, they have a couple YouTube videos, which I have here in this slide about additional resources about understanding property fluctuations. And they're fun videos about property taxes. And at that they deal with that question. So just in a nutshell, you can't pay taxes on a value above your real market value. So when people's real market values went down through what their assessed values were, now let's sum like 20%. So now you're paying taxes on the lower real market value. But the assessed value, the maximum assessed value, keeps ticking up at 3%. But let's say your real market value goes up 10% the next year. So you've gone down 20%. Now you go up 10%. Now you're paying 10% more property taxes than you were the year prior. And so people and this is why Deschutes put that video up, is they're like, wait, I thought I would only pay, 3% more. How come my taxes are going up 10%? That's because the real market value went under the assessed value, and the rules are that you pay on the lower of the two. But that is in Oregon for residential properties, not a common situation. Much more common, at least in the last 30 years, is that because of growth in Oregon and we all know about the real estate prices and that sort of thing, have really outpaced that 3% assessed value growth rate. So much, much, much more common is that the RMV has quite a gap over the AV on a residential property.
And then we've got one last question that says, is it better to have a stable amount AV or to roll with the RMV?
I suppose it depends on who you ask. Um, the taxpayer or the taxing district, because those are the different parties and they have different views. Um, so if you were to go back with just the RMV um, based system, then I think it'd be better if you went off the levy rate system, the rate-based system, and back to the levy system, so that the districts would put out what money they need, and then depending on the RMV, that's what your rate would be, and that could go up or down in any particular year. So from the district's point of view, it's kind of it's better for them. For the taxpayer, yeah, that volatility can cause some issues, and the predictability of the system that we have with the 3% growth is helpful to taxpayers, and I think people appreciate that.
Awesome. Well, we are right at 1 o'clock. Matt, did you have any other last closing words before we end this?
Nope. Just yeah, if you want to learn more, go to your local public library. No, you can click on these links. And there's a lot of information that gets deeper into what we presented today.
Yeah, and Matt, if we can get those slides from you, we'll get them posted to the TSCC website along with a recording so folks can reference back to all this great information.
Yes, and thank you everybody for joining us. We really appreciate all the engagement and everything. This was a great conversation we had today and good learning experience, and we will be planning some more of these in the future.
Excellent.
All right. I guess we can go ahead and stop the recording. I think everybody's leaving now.